So as soon as the Fed stops hiking, how do you think that the precious metals will react?
That's a great question. I think that especially silver will be the big winner of the end of this rate hike cycle. The dollar index, the DXY, it is enjoying a generational bull market that started in 2011. So we are on a 11-year bull market for the dollar compared to other fiat currencies. That's huge because the average one is about 8 years. So that's one thing. Secondly, we've seen it hitting multiple all-time highs. The most inversely correlated commodity in the world to the DXY index is silver. So once we see the Fed talking about beating inflation, counterintuitively, what that means is that the inflow towards treasuries will lessen, and perhaps we'll even see money flowing out of treasuries. Money flowing out of treasuries means that the DXY index will go down, and as it go down below 100, that is extremely bullish for silver. In this cycle, when in my opinion, the DXY index is going below 95, perhaps to 90, and I think that will correspond with silver over 40. If the dollar index actually goes below the 90 and into the 80s and into the lower 80s, I think that silver can break its all-time high of $49.50. And this is within a 3 to 4 year span. When it comes to gold, I think that gold has a chance to see about between 2,500 and 3,000. And I'll tell you a few things that are interesting about gold. In 2019, on the 1st of April, gold turned from a tier 3 asset to a tier 1 asset, according to the Bank of International Settlements, which is the central bank of central bank. When they turn it from a tier 3 to a tier 1, it means that they have a mark-to-market 100% collateral on gold. There are only two other asset classes that they allow this to. It's the US dollar and treasuries. So these risk-free assets in the eyes of institutions are really important, because on the day they changed it, gold was trading for 1,291. If you change it from 50% collateral to 100%, it means that you basically believe it's worth double what it is that day. And 1,291 times 2 is $2,582. So even in the eyes of the central banks, gold is worth around $2,600. So in my opinion, it can really extend and go into a huge rally.
One of your wealth reports is titled Gold Enters Generational Bull Market. Is that what you mean? Could you shed some more light on this?
Sure. There are multiple reasons why gold and silver are forming a generational bottom right now, as we're seeing with this rate hike cycle. Imagine what's going on right now. For many years, there was no alternative for investors other than stocks. Bonds were yielding nothing. And when you create that sort of a scenario, you are creating a world where the FANG companies were treated almost like quasi bonds. Wall Street was buying them for the appreciation, plus they were treating their dividend as a bond yield. Because if you can gain even 1% or 1.5% on Amazon or on Apple, then to Wall Street, that is a reason to pay 40 or 50 times earnings for these companies. That is over. Interest rates are going to stay elevated and normalized for years and years. So as you're creating that scenario where stocks are not the only alternative, you're creating a better equity risk premium, and that makes stocks less attractive. And in that world where stocks are less attractive, Wall Street looks for alternatives, just like in the 2000s and just like in the 70s. And that plays incredibly well for gold and silver. And now the world is changing. If you want a reliable source for your commodities, you will need to pay a premium for it. Because if lithium is coming from Latin America and the Chinese and the Americans are both bidding on it, you have to pay more. And that's what I think will happen.
Now, Germany has announced the nationalization of a former subsidiary of Russia's energy giant Gazprom. Do you think that this will impact Europe's energy crisis situation?
I think Europe's energy situation is in a reset. For about 40 years, they've relied on the petrol station of the world, Russia, to supply their net gas and their oil. And I think that's over. Whether or not Putin stays in power or there's a replacement for him, I think it will take a decade or more for the relations between Russia and Europe to come anywhere close to being orderly. And that's why I think that this energy reset is going to take years, and it's going to impact Europe big time. They have no reserves.
As you mentioned earlier on in this interview, there's been some major layoffs lately at Twitter, Meta, and recently Amazon. How do you think that this is affecting the economy? Should investors be aware or even concerned about this?
Well, actually, it's a funny question because Main Street and Wall Street look at it very differently. Wall Street loves it because it means that what the Fed does is working. People and companies are changing their behavior. They're moving from a world of let's just grow and grow and grow and develop more products and spend money and try to find new operations into a world of let's sustain our growth and get better margins. So layoffs or freezings, that is exactly what Wall Street wants to see because it means that inflation is coming under control and that we are going to have a balanced out labor market. Main Street and the banking system don't like it, obviously, because less jobs means less activity in the housing market. And I don't have to remind you that 76% of America's millionaires have come from the real estate industry, including the former president. So, I mean, real estate is the backbone of the U.S. economy, and it's in a standstill right now. Mortgage rates are too high for households, and interest rates are too high for levered up institutional buying. So I think that 2023 will be not as bad for Wall Street, but it will be a very challenging year for households and for the real economy and not the paper economy.